Hello, and welcome to our Tulane University Burke & Road Report's continuing coverage of PetroQuest Energy. My name is Andrew Grin, and I will be representing my teammates Dylan Fox, Dan Smith, and Alex Barrick. Our analyst team gives PetroQuest Energy a rating of market outperform with a 12-month target price of $7. The 5-year stock volatility of PetroQuest can be seen in the chart directly below our investment rating. The chart illustrates that over the last 5 years, PetroQuest stock price spiked at $9.25 on March 27, 2011. The company's low over the last 5 years was $3.70, reached on February 3, 2014. In our presentation, we will give an overview and company description of PetroQuest, an explanation of our valuation methodology and projections, an industry analysis, investment thesis, and summary. I will begin with the company overview and description. PetroQuest Energy is an oil and gas exploration and production company founded in 1983. The company operates in South Louisiana, the shallow Gulf Coast, East Texas, Oklahoma's Mississippi Lime and Woodford regions. The company's headquarters are located in Lafayette, Louisiana. PetroQuest maintains a strategy of using free cash flow from its shorter life Gulf Coast assets to invest and grow its established longer life assets. The company uses its expertise in the Gulf as a consistent form of free cash flow while it transitions onshore. In 2013, PetroQuest acquired new property in the Gulf of Mexico, continuing to develop this strategy. In return, PetroQuest has gained over $400 million in free cash flow from its Gulf Coast assets since 2007, as shown in the chart on the right. Additionally, since 2003, PetroQuest has diversified its portfolio into both long-life and short-life assets. This strategy sought to create balanced growth for the company and insulate it from low commodity prices in one product. This strategy is demonstrated by the company's balance of reserves in the Mid-Continent, East Texas, and Gulf Coast. Additionally, 81% of these reserves are long-life, representing the company's concern for consistent growth. As of November 7, 2014, PetroQuest had a stock price of $4.01 and a market capitalization of $264.75 million. The company's enterprise value is $645.65 million. PetroQuest has a price-to-earnings ratio of 9.78 and an earnings per share of 0.41. I will now explain our target price, valuation methodology, and valuation assumptions. Our 12-month target price of $7 and rating of market outperform are based on the PV10 valuation methodology. PV10 is the most common valuation method in the oil and gas industry. Our valuation took into account the present value of estimated future oil and gas revenues, net of estimated direct expenses, discounted at an annual rate of 10%. In order to estimate these future oil and gas revenues, we developed a reserve report for every existing well and proved reserves. Along with the reserve report, we took into account current production rates, forecasted decline rates, production costs, and indirect expenses. We also explored the enterprise value to barrels of oil equivalent valuation method, also known as EV to BOE. This valuation also gave us a target price of $7. However, it was not used as our primary valuation method because the EV to BOE method does not take into consideration potential production from undeveloped fields. It's important to note that for both valuations, we used commodity price forecasts based on data from the Energy Information Administration, as well as other sources. While these commodity prices were updated in October, our valuation method does not take into account oil prices below $85. I will now explain some of the major trends of the oil and gas exploration and production industry. Over the last 7 years, a shale revolution has been occurring in the United States. Since 2007, shale gas production has increased 51% per year, making the United States the world's largest producer of natural gas. The massive increase in production from the United States shale plays has been brought on by advanced hydraulic fracturing and drilling techniques that have increased production around the country. One of the current trends of the oil and gas industry is to focus on development of high-priced commodities. When natural gas prices spiked in 2008, there was a significant overproduction of natural gas, leading to a decrease in prices. A similar trend in the oil market appears to be occurring today as oil prices have fallen to $75 a barrel from over $100 a barrel in less than 6 months. We will now discuss the primary drivers of our investment thesis, including PetroQuest's recent production growth, the Thunder Bayou prospect, the Woodford joint venture, the effect of low commodity prices, and PetroQuest's use of leverage to finance growth. PetroQuest production has grown significantly since 2010. The company has realized a 45% increase in production per day and a 56% increase in proved reserves. The company hopes to continue this growth with the addition of the Thunder Bayou prospect in the Louisiana Gulf Coast. PetroQuest has experience in the surrounding basins and will likely announce its expectations for the well in the second quarter of 2015. PetroQuest is currently partnered with Nexera to operate a series of wells in the Woodford region. The joint venture requires PetroQuest to pay 25% of the expenses in exchange for 50% of the revenues. While the joint venture has been highly successful for PetroQuest, the agreement will expire in the second quarter of 2015. In an effort to replace the lost production from the Woodford play, PetroQuest will reallocate these capital expenditures to the Cotton Valley field. We expect the company to drill 18 to 20 wells in this region in 2015. After the spike in natural gas prices in 2008, PetroQuest increased its position in natural gas liquids and crude oil. This move exposed PetroQuest to the current drop in oil prices, which could significantly impact PetroQuest's strategy of using free cash flows to fund new operations. In addition to the drop in crude oil prices, PetroQuest is severely underhedged in 2015. The company has only hedged 10 billion British thermal units of natural gas at a price of $4.16. As a result, PetroQuest will be exposed to oil and natural gas liquids price fluctuations in 2015. PetroQuest has recently increased its leverage to fund production growth, and as a consequence, the company's debt-to-equity ratio is significantly higher than its peer group at 3.24. Much of PetroQuest's leverage can be attributed to the Gulf of Mexico acquisition, where, in 2013, the company issued an additional $200 million in 10% senior notes. In total, PetroQuest has $350 million in 10% senior notes that are payable in 2017. We expect the company to refinance the notes in 2015. However, this process will subject the company to increased interest rate risk. In conclusion, while it may be important to monitor the risk factors outlined in our investment thesis, we give PetroQuest a market outperform rating with a 12-month target price of $7. Thank you for listening. For more information on our analysis, please reference our full report on the Burke & Road Reports website. The Burke & Road Reports are produced solely as part of an educational program of Tulane University's A.B. Freeman School of Business. The reports are not investment advice. Investors should not regard the presentation as a recommendation to sell or buy any securities mentioned. Investors should consult an investment professional and/or conduct his or her own primary analysis before making any investment decision.